Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, welcome back to the fifth video of investment account chapter. Now in this video we are going to solve this illustration 7 of the study material, and in this problem we have got variable income bearing security. Yes, now in the previous video we have understood everything regarding variable income bearing securities, have we not? Yes, we have. Yeah, the concept, and then how the dividends are paid, and there are two types of dividend: post acquisition dividend and pre acquisition dividend, and then the accounting treatment of that. If it's a post acquisition dividend, then what do you have to do? You have to take it to profit and loss, simple income. If it is pre acquisition dividend, then what you have to do? You have to deduct it from the cost of investment. Yeah, and investment accounts, how you're going to do that? In investment account for post acquisition dividend, where you're going to take it? You're going to take it in the dividend column, and that would go to where? To profit and loss. Yeah, and then in case of pre acquisition dividend in investment account, what you're going to do? You are going to take it in the investment column on the credit side. You're going to reduce the investment by crediting it. Is that clear? Yes. And then we also discussed about final dividend and interim dividend. Yes. And how do we have to treat that? And then bonus shares, when we have bonus issue, what we have to do? Just the number of the shares would increase and nothing else. Yeah, there is no cost because we don't have to pay anything as an investor. We get the bonus shares as an existing shareholder of the company, and we get that for free. Yes. And then we also saw right issue, what we have to do when there is a right issue. When you get the right, when you get that hak, what you can do? Either you can subscribe the shares of the company depending upon whatever the ratio is, or what you can do is partially you can also sell the right and get the money, right? And that money, that income would go to profit and loss. That also we saw. And then we also discussed this format of investment accounts in case of variable income bearing security, which is the content is there and everything, and all these notes and everything. Yeah, so please make sure you have watched this video because this is a very important video. Yeah, fourth video of variable income bearing securities. Right, now let's get back to the question. Let's understand this question. Now here we have the question. Let's go through it once. Let's try to understand what is happening over here and in which sequence it is happening. That's the most important part. Yeah. Yes, so see, on 1st January 2011, Singh had 20,000 equity shares in X Limited. Now here, who is the investor? Mr. Singh is the investor. Here the investor is a person. Now the investor can be a company, can be a person, it can be anybody, yeah? But here we have to see what from the point of view of investor, because we are doing investment accounts, not issue of shares, buyback of shares, okay? Don't see from the point of view of X Limited, the issuing company. No, you have to see from the point of view of Mr. Singh, the investor. Fine. So from this first sentence, we come to know that here they are talking about opening balance. Yeah, Mr. Singh has got opening balance because here they are saying on 1st January 2011, he had 20,000 equity shares. So he had it from previous year. Yes. So you have to go down noting down the sequence of events. Okay. So the opening balance is how much? The opening balance is 20,000 equity shares. And what's the cost of that? The price? See, 20,000 equity shares, then nominal value of the shares was rupees 10 each. Now this is the nominal value they have given us. Okay, so that would be same for the entire thing. So nominal value rupees 10. Yeah, that's not the cost. Then they're talking about the cost over here. See, but their book value was rupees 16. Now this is the cost, the book value. Yeah, rupees 16. Fine. So when we will be taking the opening balance in the investment account, what are we going to take? We are going to take 20,000 number of shares into its cost into 16 per share. That's equal to 3,20,000. So 3,20,000 will go to investment account as an opening balance. Yeah. Yes. Then what? On 1st June 2011, Singh purchased 5,000 more equity shares in the company at a premium of rupees 4 per share. Yeah. So what is happening then? On 1st June 2011, Mr. Singh has purchased additional 5,000 shares. Yeah. So purchase in current year. Yeah. Purchase in current year. So he has purchased 5,000 shares, and what's the price he has purchased? At what price? At a premium of rupees 4 per share. Premium on what? Premium on the face value. Yeah, over the face value. So he has purchased it for rupees 14, isn't it? See, nominal value, face value is rupees 10. Premium of 4 means what? Over the face value. Yeah, that's rupees 14. Simple as that. Yes. Then what happened? See here, on 30th June 2011, the directors of X Limited announced a bonus and rights issue. Bonus was declared at the rate of 1 equity share for every 5 shares held, and these shares were received on 2nd August 2011. Now here what is happening? The company is going for bonus and rights issue. Yeah. So the bonus is happening first. See here, bonus was declared at the rate of 1 equity share for every 5 shares. if you have 5 shares of the company is giving you 1 equity share for free. If you have 5, अगर आपके पास 5 शेयर है, एक कंपनी फ्री में दे रही है, right? So bonus issue is happening. Yeah. So how many shares do we have right now? We have 25,000 shares in total. Yeah. Opening balance 20,000 and 5,000 we have purchased in current year, and then the bonus was declared. Yeah. So our existing holdings is what? 25,000 shares. Yeah. And on this we are going to get how many shares? 1 shares for every 5 share held, right? So we have 25,000 holding, and then the company is going to give 1 share for every 5. So 1 by 5, right? Yes. So how many shares are we getting for free? For free we are getting how many? 25,000 into 1 by 5, that's equal to 5,000. Yeah, isn't it? Yes, 5,000 shares we are getting for free. And then what happened? See here, then they're talking about the rights issue. The terms of the rights issue were, see here, right shares to be issued to the existing holders on 10th August 2011. Fine. Right issue would entitle the holders to subscribe to additional equity shares in the company at the rate of 1 share per every 3 share held at rupees 15 per share. Now you know, right? Right issue is not for free, okay? Right shares are not free. You have to subscribe. Yeah. Bonus is free. That's capitalization of profit. But right issue is what? Right issue means they are giving you a right. Yeah. हक दे रहे हैं आपको. With that piece of paper, with that option, right, what you can do, you can purchase the shares of the company at a reduced prices, isn't it? So maybe the market price is somewhere, you know, I don't know, it could be more at that time, but here they are giving rupees 15, right? That's what. So here the ratio is what? 1 share per every 3 held. The option is what? If you have 3 shares in our company, you would be able to purchase 1 additional share. Yeah. अगर आपके पास 3 शेयर है, आप 1 शेयर परचेज कर सकते हो, 1 शेयर पर every 3 share. Yeah, so 1 by 3 is the ratio. So see, right issue is happening, and right issue is only given to whom? Only to the existing shareholders, right? So how many shares do we have? 20,000, 5,000 and 5,000 bonus. So in total we have 30,000 shares. 20 plus 5 plus 5, that's 30,000 shares we have right now. And then the ratio is 1 by 3, isn't it? 1 by 3, right? 1 share per every 3 held, isn't it? Yes, 1 by 3. And then we also have to pay a price. But let's see what happens, because with the right issue, what you can do, if there is a right issue, what the shareholder will get? He will get a right, he will get a piece of paper. Then what he can do is either he can subscribe the shares fully, or what he can do is he can sell the right fully also, or he can do, you know, partially also. He can partially 50% or 75%, you know, purchase the shares, subscribe the shares, and the remaining 25%, what he can do, he can sell the right also. The right, okay, this he can sell the right, not the shares. Yeah. So see, existing shareholders were entitled to transfer their rights to outsider either wholly or in part. Yeah, that's what I said. And then Singh exercised his option under the issue for 50% of his entitlements, and balance of rights he sold to Anand for a consideration of rupees 1.50 per share. You see what he has done? This Mr. Singh, he has only taken up 50% of the entitlements. Yeah. See here, 30,000 into 1 by 3, he was offered 10,000 shares. Yeah. He could purchase, he could subscribe 10,000 shares in this right issue which company went for. But what he did, only 50% he subscribed. Okay. Only 50% he subscribed. So that means he subscribed how many shares? Only 5,000 shares, isn't it? 50% of 10,000. And then the remaining 50%, the remaining 50%, what did you do? The remaining 50%, 5,000 shares, yeah, the right to purchase these 5,000 shares, he sold it to Mr. Anand. Yeah, he sold it. Yeah, sold to Anand. Yeah, what did he sell? He didn't sell the shares, he sold the right. Sold to Anand. Okay, right has been sold. Right to what? Right to purchase this 5,000 shares. Is that clear? Yeah. So, and he sold that for 1.50 per share. Now this is an income for him. Yeah, a normal income which would go to profit and loss. Simple as that. Yeah, simple income. You don't have to take this into investment account. Okay. Yeah, you have to prepare a small working note below that. You know, 1.50 into 5,000 per share, right? So 1.50 into 5,000. See here, 1.50 into 5,000. How much is that? So 7,500 is an income for Mr. Singh, and it would be transferred to profit and loss. Okay. Yes. Then what? Then as you can see, dividends for the year ended 31st March 2011 at the rate of 15% were declared by the company and received by Mr. Singh on 20th October 2011. Now what has happened? The dividend has been declared. The dividend of what? The dividend of 15%. And dividend is always calculated on what? Always calculated on face value. So you know the final dividend is always calculated upon what? On the previous year's capital, isn't it? Whatever that was outstanding in the company's balance sheet in the previous year, on that equity share capital. So what was outstanding? The opening balance and the purchases of current year, yeah, because you have purchased these shares from someone who was the owner of the shares in the previous year, yeah. So that's one. So the dividend will be calculated upon what? Only upon the purchase of current year, which is, you know, pre-acquisition dividend, and on the opening balance, that's post-acquisition dividend. I hope you know that, right? We have discussed that in very much detail in the previous video, yeah. If you have opening balance and on that if you're getting the dividend, then that's post-acquisition dividend, because you were the owner of the shares in the PY for which the dividend is declared. You know that, right? The dividend, how the dividends are declared in the company, the dividend of this year of a certain period is declared in the next year, and here we are preparing the investment account, so we'll be having an opening balance over here. Yes, so on that opening balance you will calculate what? Post acquisition dividend, yeah. 15% on opening balance is what? It is post acquisition dividend. And then if you're purchasing some shares in the current year from someone who had the shares in the previous period, but you are becoming the owner of the shares in this period, yeah, you're purchasing in the current year before the record date, yeah. Record date means what? Date at which those who own the shares will get the dividend. So your name is coming in the list of the company on the record date, so you will get the dividend, right? And that dividend is called as pre-acquisition dividend, yeah. You purchase the shares in the current year before the record date, and you are getting the dividend of pre-period. So that's why it's called pre-acquisition dividend. And what was the accounting treatment for that? I hope you know all these things, yeah, because we have discussed very much detail these things, yeah. Pre-acquisition dividend, deduct from cost of investment, and post-acquisition dividend, you have to treat it as simple income and take it in the dividend column. Here, reduce it from the cost of investment, so you have to take it in the investment column. Yes, so on opening balance, post-acquisition dividend, on purchase in current year, pre-acquisition dividend. Is that clear? Yes, yeah, that's what. Okay, and then what? On 1st November 2011, Singh sold 20,000 equity shares at a premium of rupees 3 per share. So here Mr. Singh has sold at a premium of rupees 3. At last what he has done, he has sold 20,000 shares, yeah, he has sold 20,000 equity shares at a premium of rupees 3. At a premium of rupees 3 means what? Nominal value is rupees 10 over the face value of rupees 3, that's equal to rupees 13, isn't it? So at this price he has sold the shares. Fine, that's simple. Then what? The market price of the share on 31st 12 2011 was rupees 14. Now the market price at the closing date has been given to you. Why is this given to you? Because you can value the investment at last, yeah, the closing balance. Now here they didn't say anywhere that these are long-term investment, yeah. So we have to assume this is a current investment and solve the problem, okay, because it's not mentioned anywhere that it's a long-term investment, yeah. So what we have to assume, it's a short-term investment. Is that clear? Yes, it's a short-term security, and we have to, you know, value it at the lower of cost and fair value. So the market price is 14. Now at last we have to do a WACC calculation. We have to see what is the cost, yeah, what is the WACC price, and compare it with those two, and whichever is lower you will use that for the valuation. Show the investment account as it would appear in Singh's books on 31st 12 2011 and the value of shares held on that date. Fine, let's do that, yeah. Let's solve this problem and let's prepare the investment account. Now here we have the solution. Let's understand how to prepare this investment account and all. See, it's very simple. First, let's just recall the format. So the format is very simple. What are we doing over here? We are preparing two accounts. An investment account, which is an asset account, so it has debit balance, and another account we prepare, as you can see here, dividend column, that's dividend account, yeah, which is an income account and it has credit balance. And when you purchase and sell the shares, what you have to do, how are you going to do recording of that? Simple. When you purchase, it will come on the debit side to bank account, because you are getting the investment, your investment is increasing, so you have got to debit the investment account debit to bank account, because you have paid the money and you have to take that in investment column, right? And when you sell the shares, what you have to do, you have to take it on the credit side by bank account. Yes, investment is reducing, you have sold off the shares, so it will get credited. Yes, investment account credit by bank account here. Is that clear? Yes, simple. And then what you have to do, final dividend and interim dividend. Now final dividend, you all know that you have to calculate final dividend on what? On the opening balance and the purchases you have made, purchases of shares you have made in this year, in current year, right? On the opening balance it will be post acquisition dividend, and on the purchases you have made in this current year would be what? Pre acquisition dividend. isn't it? Yes. And then we also have interim dividend. Now in this question there is no interim dividend, but if you have interim dividend, then it will be calculated on everything: bonus shares, right shares, purchases, everything, right? Opening balance, everything. Yes. And then what? And then the closing balance will be there, which you have to value according to FIFO or WACC. Now in this problem we are going to see WACC. All right, because nothing is said in the question, so whenever the question is silent regarding the valuation, always you have to go with the WACC. Is that clear? Weighted average cost. Yes. And then after doing the closing balance, what you will have to do, you have to find out the balancing figure, and balancing figure of both the accounts, investment account as well as dividend income account, will hit where? It will hit profit and loss. Okay, now coming to the investment column, the balancing figure would be what? Balancing figure on the debit side would be profit, yeah, profit, and on the credit side would be loss on sale. Is that clear? Yes. And then dividend will always go to where? It will also go to profit and loss, because it's an income account, right? Nominal account, which has to be closed, right? So that's what it will go to, profit and loss, right? Simple. Yeah, that's all the problem. Now coming back to the investment account, see here, first what you have to do, first you have to take the opening balance. Yeah, do we have the opening balance in this question? Of course we have 20,000 equity shares, right? And the value was what? Rupees 16, the book value. So 20,000 into rupees 16, that's equal to 3,20,000. We already calculated that, isn't it? So that's what you have to take in number of shares. You have to take 20,000 shares and then 3,20,000. How did I get that? See here, 20,000 shares is the opening balance into book value rupees 16, that's equal to 3,20,000. Simple. Then what? Then what happened? Then as per our sequence, you know, we have purchased in current year how many shares? 5,000 shares at the price rupees 14, isn't it? See the question. We have purchased, right, on 1st June 2011, 1/6/2011, we have purchased 5,000 shares at a premium of 4, so that was 14 rupees. We have already seen that, so that's equal to 70,000. How? See here, 5,000 equity shares into rupees 14, that's equal to 70,000. Simple. To bank account. Yes, investment account is increasing. Yeah, debit that, and then what you have to do, you have to take here to bank account. Simple as that. And then what happened? Bonus issue, right? So bonus was how much? 5,000 shares. We have already seen the calculation. We had 25,000 shares, and then the question says that 1 for every 5. Yeah, bonus equity share is for every 5 shares held, 1 equity share for every 5 shares held. So 1 by 5, we have already seen the calculation. See here, 20,000, 5,000. We have 25,000 shares. 25,000 shares we have into 1 divided by 5, that's equal to 5,000 shares. So 5,000 shares we are getting for free, completely free, so no cost. Yeah, you haven't paid anything, we haven't paid anything, so nothing, right? So that's regarding the bonus shares. And then what happened? And then come to the right issue over here. See what happened? Right shares to be issued. Yes, right issue would entitle the holder to subscribe to additional equity shares in the company at the rate of 1 share per every 3 held. Now so far how many shares do we have? We have 25,5, that's equal to 30,000 in total. In total we have 30,000 shares into 1 for every 3, isn't it? The fraction is 1 by 3. We have already seen that calculation, isn't it? 1 by 3. So if you put that into calculator, into 1 divided by 3, that's equal to 10,000 shares. But did we subscribe to all 10,000 shares? No, we didn't. We subscribed only, Mr. Singh subscribed only 50% shares. So you have to take only 50%. Yeah, into 0.50, 50%, right? So that's equal to 5,000. Now these are the number of shares that have been taken up or subscribed by Mr. Singh. Yeah, these are the number of shares. Is that clear? So number of shares would be 5,000, but then there is also price, right? What was the right price? The right price was rupees 15 per share, isn't it? So into rupees 15, that's equal to 75,000. So that would come over here. Is that clear? Is that simple? It's very simple, right? And you have paid the money for that, right? So to bank account. Yeah, for bonus shares you haven't paid anything, so you can't take to bank over here. Yeah, you're just getting the shares for free, only the number of shares are increasing. Yeah, the cost is not changing because you haven't paid anything, but here the cost is increasing. You have paid money, investment account is getting debited, right? Yes. And then what happened? And then see, you also sold, right? Here you sold 50% of the shares, 50% of the rights shares at what? 1.50 per share. You didn't sell the, you didn't sell the shares, you sold the right, the paper from which you can subscribe 50% of right shares. Yes, so that was 1.50, so that would go to profit and loss. Okay, small note you have to write down below that and show the calculation over there. Okay, 1.50, I have already shown you this. 1.50 into what? Into 5,000, so that's equal to 7,500. You have to take that as a working note down below. Simple. Then what? Then dividend, right? See here, Dividends for the year ended 31st March 2011 at the rate of 15% were declared by the company and received by Mr. Singh on 20th October 2011. Yes. Now the dividend, see here, regarding the dividend, I've already told you everything regarding dividend, yeah? So directly I will show you how to calculate. See here, it's very simple. Dividend, there are two types of dividend, pre and post, yeah? Post is on opening balance and pre is on the purchases you have made in the current year. And dividend is always calculated on the face value, and this is final dividend we are talking about, okay? Not interim dividend, final dividend, yeah? So what would happen to post? Post would go to dividend column because it's treated as simple income, and pre is treated as a capital receipt, so it is deducted from cost of investment, yeah? Investment account, on the credit side, investment will be credited, it will be decreased. Is that clear? It will be deducted from cost of investment. So see the calculation here, very simple calculation. Let me show you the calculation here. See the calculation here. What have we done? See, this is the opening balance. On opening balance we calculate post acquisition dividend, right? So see here, 20,000 is the number of shares, then the face value is rupees 10 into 10, so this is the total face value of 20,000 shares, 2 lakh, yeah? So on this 2 lakh you have to calculate 15%, yeah? 15% dividend was declared, right? See here, rate of 15% dividend, yes? So 15% dividend into 0.15, that's equal to 30,000, that's equal to 30,000. So that 30,000 would go where? In dividend column, yeah? Because post acquisition dividend is treated as normal income, normal receipt, revenue receipt, and it is taken on the, it is taken directly to the profit and loss. So first it will go into the dividend column, and then as a balancing figure it will go to the profit and loss. Is that clear? So that's what you have to do. Did you understand the calculation? Simple calculation, man, very simple calculation. On the opening balance, the dividend which you get, that's post acquisition dividend, simple normal income, you have to take it on the credit side of dividend account. Simple? Yeah, so that's what I did. Simple? Yeah. Then we have one more dividend, that's called pre-acquisition dividend, yeah? And you have to calculate that on the what? On the purchases you have made on the current year. And 5,000 is the number of shares you have purchased in the current year. But what's the total face value? 5,000 number of shares into rupees 10 face value, that's equal to 50,000 total face value. So on that 50,000 total face value, you have to calculate 15%, you will get 7,500. See, 50,000 into 0.15, that's equal to 7,500. So 7,500 has to be deducted from cost of investment, COI, yeah? So how are you going to do that? You have to take it on credit side of investment account. So investment account will get credited. Yes, investment account credited. Is that clear? Yes. So you have to take it over here, 7,500. Okay, within one posting only you have to take it, okay? Yeah, don't waste the time, right? So that's what you have to do. You understood this calculation, right? Simple calculation, yeah. Then going forward, what do we have? And then what happened? You have made sales. See, Mr. Singh sold on 1st November 2011. Singh has sold 20,000 equity shares at a premium of rupees 3 per share. Yeah, he has sold, right? So sold means what? Where it will come? Credit side. Investment are being sold, it will get credited, right? So it will come by bank account. You're getting the money. How much did he sell? He sold 20,000 shares, 20,000 equity shares. So 20,000, and he sold at a price of rupees 3 per share. Rupees 3 premium. Yeah, premium of rupees 3 per share. Yeah. So 10 was the face value plus 3, yeah? So that's 13, yes? So at this price he sold the equity shares. So 13 into 20,000, the number of shares he sold, that's equal to 2,60,000. So 2,60,000 money he received, Mr. Singh received. Is that clear? 20,000 shares sold for 2,60,000. Simple? Yes. Then what? Then what you have to do, everything is done, yeah? Everything is done. See, our sequence, entire sequence is done. Opening balance, purchase in the current year, bonus shares, right shares, yeah? 50% only we subscribed, 50% we sold, the right we sold. And then what? We got the dividend, yeah? Post acquisition dividend in the dividend column, pre acquisition dividend in the investment column. We reduce the cost of the investment, yeah? तो अब क्या हुआ है? Now what has happened? See here, इसका जो cost था हमने इधर reduce कर दिया है. So what is the cost of the purchase we have made in the current year? Not 70,000. 70,000 minus 7,500. Keep that in mind, okay? In white calculation. Because जब हम cost लेंगे इसका, हमको cost ये 70,000 नहीं लेना. We don't have to take this 70,000. No, we have to take net of these two. 70,000 minus 7,500. That's equal to 62,500 something, yeah? Yes. So we'll see that, don't worry. So everything is done. Now what we have to do, we have to find out the balancing figure. Not the balancing figure, sorry, the closing balance, yeah? So see, number of shares, we had 20,000, yes, and then we purchased additional 5,000, and then we got 5,000 bonus shares free from the company, and then we subscribed 5,000 additional shares from the right issue plus 5,000. So we had total 35,000 number of shares. Yeah, and then what we did, we only sold off 20,000 of equity shares. So minus 20,000, that's equal to what? 15,000. Now we are left with 15,000 number of shares. So that's our closing balance. ये क्या है हमारा closing balance? इतना हमारे पास बचा हुआ है because we have sold 20,000 shares, right? So out of 35,000, only 15,000 have been left. Now this has to be valued according to what? FIFO or WACC. Now the question is silent. The question doesn't say anything anywhere, right? FIFO or WACC. So what we have to do? Only the market price is given. So now what we have to do? We have to go with the WACC. Always remember, जब भी question silent होगा, whenever the question is silent regarding the valuation, always you have to go with the WACC. Okay, fine. Yeah. So see, how are we going to do that? How are we going to value the closing balance through WACC? See, it's very simple. Let me show you how simple it is. See, the box approach you can use. It's very simple. See, whatever acquisitions you have made, how you have got the shares, take all of them in the boxes. Yeah, you had opening balance, yeah, and then you had purchased 5,000 equity shares. These are the quantity I'm taking over here: 20,000 equity shares, 5,000 equity shares, and then we got bonus shares 5,000, right shares 5,000 quantities. Yeah, number of shares. Yes, and then what you have to do, you have to take cost over here, all the cost. Now see, the opening balance cost was given in the question. Yeah, the book value of opening balance was rupees 16. So I took that rupees 16. But when I purchased it for how much? I purchased it for that at 5,000. I purchased it for, see here, at a premium of rupees 4 per share. So 14 rupees, isn't it, over the face value? Isn't it? We purchased the current year shares at 14. But can we take that price rupees 14 here in WACC calculation? No, we can't. We can't do that. That's what I said. We purchased it for 70,000. But uska abhi cost kya 70,000 hai? No, it's not, right? The cost of these shares is not 70,000. Why? Because we have deducted the dividend, the pre-acquisition dividend from the cost, right? So the cost has been reduced. See here, we paid 70,000 for that purchase we made in current year. But when we received the dividend on that 70,000 on that shares, what did we do? We deducted it from the cost of the investment, minus 7,500. So that was equal to 62,500. Yeah, 70,000 को purchase किया, उसके बाद dividend मिलने के बाद minus किया, cost of investment, credit किया ना इधर investment account, isn't it? So the real cost, the net figure is 62,500. This is the real cost now. So this cost you have to consider 62,500. Okay, and then you have to divide it by what? Divided by the number of shares. 5,000, right? 5,000 you purchased, right? So 5,000 divided by that, you get the price as 12.5 rupees. 12.5. समझ में आया? Simple. So that's what. Okay. So 62,500 divided by 5,000. So that's equal to 12.5. So 12.5 is the price now, the actual cost per share. It reduced. Why did it reduce? Because you have deducted, right? You have reduced the cost by deducting the dividend from the cost. Yes, simple. So did you understand how did I get this 12.5? Easy, right? Yeah. Then bonus shares. Now bonus share didn't have any price, right? We got that for free. So price is 0. Is that clear? No cost for that. Then for the right shares, we paid rupees 15, isn't it? For right shares, we paid rupees 15, right? See here the question. Where is it? See here, right shares, rupees 15, right issue, rupees 15 per share. Isn't it? Yes. Right shares never for free. Always you have to pay something, but it will be at reduced prices. Okay. So 15. So that's what. You got the boxes. Now, where you have sold? You have sold over here. After these 4 events, you have sold 20,000 shares. Yeah. So you have sold 20,000 shares. When you sell 20,000 shares, what you have to do in this calculation? Immediately you have to write what is the balance left. The balance left is 15,000. We have seen that calculation, right? See here, simple. 20,000 plus 5,000, 5,000, 5,000. Yeah. So 15,000. So that's equal to 35,000. We had 35,000. And then after these 4 events, after these 4 boxes, we sold 20,000 shares. So minus 20,000. What's the balance left? The balance we have, the quantity of shares is 15,000. Yes. Now what we have to do, we have to calculate the WACC, weighted average price, weighted average cost. Yeah. So how do we do that? See, it's very simple. All you have to do is take the cost of all these 4 boxes, the cost divided by the total quantity, the total number of shares. That's all. Simple. बहुत simple है. देखो क्या करना है. See here, 20,000 into 16, 5,000 into 12.5, 5,000 into 0, that's 0. Yeah. 5,000 into 0 क्या होता है? 0 ही होता है, right? Nothing. 5,000 into 15 is, yeah, like that you have to take and divide it by total number of shares 35,000. Okay, number of shares मिलाओ कि कितने होते हैं 35,000, right? So how will you do that in calculator? And you have to do this properly. Okay, don't mess up this calculation because you have to take all the decimals so that you can get an accurate answer. Yeah, so see, both simple hai. See, 20,000 into 16 m plus 5,000 into 12 m plus, yeah, sorry, not 12, it's 12.5, right? So let's do that again. 20,000 into 16 m plus 5,000 into 12.5 m plus, and then here 0, leave that 0. 5,000 into 15, so 5,000 into 15 m plus. Then you have to do memory recall, MRC button. Yeah, so you get something divided by 35,000, that's equal to, see here, 13.07, some decimals are there. So now what you have to do, you are already done with all this, right? And you have the balance here also. You don't have the WACC now, you just got the WACC. But now don't write it down like that. See what you have to do, immediately you have to multiply the balance, 15,000. Okay, so what's the price now? 1,96,071. Yeah, 1,96,071 rupees, and 0.4 something is there. So that's your closing balance value. Is that clear? That's how you have to do. If you just take two decimals and all, you will mess up, you will not be accurate, you will make mistakes. What you have to do, after doing the whole calculation with that m plus memory recall and all, whatever decimals, all the decimals you have got, just multiply it with the closing balance, the quantity of the number of shares you are left with, you will get the closing value. Simple as that. That's all you have to do. This is the WACC calculation. Is that clear? Easy, right? Yes, this is all. Yeah. So once you get that, what you have to do, you have to take that to the investment account in the closing balance, buy balance, C by D closing balance, 15,000. Yeah, this is the number of shares, you already know that, and then take that 1,96,071, this thing. Yeah, yes. Now I didn't tell you the most important part. See, the most important part, what you have to do, this is the closing value, you know that. Yeah, now you have to compare this closing value. You can't directly take it. What you have to do is, you have to see over here, because we are assuming that this is current investment, and we know the current investment is, valued at lower of cost and market value, fair value. Yeah, and the market value is given at the closing date as rupees 14. So we were left with how much? We were left with 15,000 shares. 15,000 shares into rupees 14. Yeah, 14 is the market value. So that's equal to how much? 2,10,000. So 2,10,000, and here through WACC we have got 1,96,000. So which is lowest? The lowest is this one, the cost price. This is the cost price, right? Weighted average cost. This is the cost. This is the market value. Tell me which is lower. Of course, this is lower. So you have to take this in the investment column. That's how you have to go about this. Not just directly do calculation and just pick this and put it over here. No, you don't have to do that. Compare first. Yeah, first compare. Whichever is lower, current investment. We are assuming this is current investment, and current investments are valued at according to AS 13, lower of cost or fair value. This is the fair value, this is the cost. See, this is lower. You have to take that. You understand that? Yeah, simple thing. Yes. So that's the balancing figure. I mean the closing balance. And then what you have to do? Find out the balancing figure. Simple. See, the balancing figure. Simple. Now first do the dividend column. In the dividend we only have this 30,000, nothing else, right? So 30,000 on both the sides, and it will go to profit and loss. Okay, it will hit profit and loss because it's an income account, right? Nominal account. All nominal accounts are closed. So that's what we are doing over here. Dividend account is being closed at the end of the year, and it is being transferred to where? It is being transferred to profit and loss on the credit side. It's an income, right? Here it will come on the debit side in the dividend column. In the profit and loss it will go on the credit side, right? Then what? Then the investment column, we have to tally this investment column. See here, let's go from the debit side. 3,20,000 plus 70,000 plus 75,000, that's equal to 4,65,000. Yeah, 4,65,000. Then go on subtracting here, minus 7,500 minus 2,60,000. Yeah, minus 1,96,071, that's equal to 1,429. So we are getting a shortfall on the credit side. Yeah, debit side is bigger and credit side is shorter. Is that clear? So the balancing figure is on the credit side. What does that mean? It means that that's loss on sale. Yeah, we have incurred loss from this investment in this year. It's simple. That's all you have to do. So 1,429 is the balancing figure, and it would go to profit and loss as loss on sale. Here it is being credited in profit and loss. What will happen? It will go on the debit side because it's loss, right? all losses are debited, all incomes are credited in profit and loss, isn't it? Yes, simple man, it's very easy. So that's all you have to do. How hard was that? Very simple, yeah. You understand the WACC calculation properly, easy WACC calculation, yeah. And then this pre-post acquisition dividend is also not a big deal. It's very simple. Pre-acquisition dividend in which column? In investment column, reduce it from the cost of the investment. Post acquisition dividend in dividend column, yeah. And post acquisition is calculated upon the opening balance, post upon the opening balance, pre upon the purchases you have made in the current year, okay. And never calculate the final dividend on these, okay, on bonus shares and the right shares. Always remember that. See the notes over here. Final dividend only calculated on previous year capital. What was capital that was outstanding in the balance sheet of the company in previous year, because dividend is also of previous year. फाइनल डिविडेंड कब का होता है? ये जो डिविडेंड दे रहे हैं, ये डिविडेंड कब का है? पुराने साल का है, नॉट ऑफ 2011. या नो, इट वाज ऑफ 2010-11, पुराने साल का था, राइट? सो दैट्स व्हाई you have to calculate it on what? Previous year closing capital, okay, not on fresh issue that you have made in this year. अब ये जो परचेज कर रहे हो ना, ये करंट ईयर का नहीं है. परचेज करंट ईयर में कर रहे हो, यू आर परचेजिंग इट इन करंट ईयर, बट एक्चुअली दीज शेयर्स बिलोंग टू व्हाट? टू प्रीवियस ईयर. सम इन्वेस्टर वाज देयर हु हैड इट इन प्रीवियस ईयर, सो दैट कैपिटल वाज ऑलरेडी आउटस्टैंडिंग इन द कंपनीज बुक्स इन एक्स लिमिटेड कंपनी. समझ में आ रहा है? तो एक्स लिमिटेड जब शेयर्स देगी, आई मीन द डिविडेंड देगी, वो किस पे दे रही है डिविडेंड? फाइनल डिविडेंड ओनली ऑन द प्रीवियस ईयर कैपिटल, प्रीवियस ईयर क्लोजिंग कैपिटल, नॉट ऑन फ्रेश इशू, नॉट ऑन बोनस शेयर्स एंड द राइट शेयर्स. बट इफ यू हैव गॉट इंटरिम डिविडेंड, then interim dividend will be calculated on everything, okay. And sale of right nahi lena, okay. Either sale of right will go where? It will go to profit and loss directly. You have to just show a simple calculation down with this a simple working note. That's all, yeah. So this is it. It's easy, right? Yeah, that's all. Yeah, if you have any doubts, then please comment down below, okay. And we have also made our Telegram channel, so there you will find the scanned notes of all of these. Yeah, okay, then see you in the next video. Yeah, bye.